perfect is the enemy of good, right? I want to take a strategy and then kind of add in some defensive stuff to it, just to make it, I think, a little more robust and be a little bit more comfortable out of sample.
Hey everyone, today's podcast episode is actually sponsored by us here at Predicting Alpha. If you're an ambitious options trader who understands that data is the key to building a profitable trading strategy, all you need to do is click the link below. You'll get 14 days of free access to everything you need to take your game to the next level. You're going to get the education that will teach you how to think like a quant and what trading with an edge really looks like. You'll get the data you need to go out and actually find a real edge in the market. And you'll get to meet a community of like-minded traders who work together to beat the market. If that sounds good to you, just click the link below. 14 days, no obligations. It will change the way you think about trading forever. With that being said, enjoy the show.
I'm currently a teaching professor at Northeastern University. I've been here this is my third year, and my career or my path is a little unusual. So originally I came out of school a long time ago, and I was trading, I got a job trading, or being a clerk really, trading commodity options. And from there, I went through a couple of different places, all on the sell side, so working for a bank or brokerage house, trading primarily options, commodity options, equity options, and then a little bit of currency options. And that was primarily on the sell side. So what you're doing there is sort of facilitating customer flow, taking some positions, but more about helping and assisting the customer, which was interesting in some ways, but I always thought that I'd like to take risk, create something if I could, and see if it works. So I kind of wanted to get to the buy side. So if you can hear that in the back, I wanted to be at school because I thought it would be quiet, and there's something going on outside. So I apologize for that.
You're actually you're getting away with it. Not hearing
okay.
anything.
All right. So I ended up joining a vol firm in 2005 and was there for 4 years. And I ran the primarily the commodity space. So I traded all the equity options on commodity names, so mining and energy names primarily. And then I also traded the underlying commodities. We had a long volatility bias. We did well during the financial crisis. I took a long vol strategy elsewhere after that, and precisely the wrong time. And then I said, you know what? I'm tired of this, and I went back and got my PhD, and so now I'm in academia. I like it a lot. I'm starting to get the itch to go back and work a little bit. I'm talking with a fund, and we're starting to work on some things, which is pretty exciting. That's taking some of my research and trying to implement it in various ways.
Getting back in the game.
A little bit, yeah.
Nice. I actually think a good place to start is talking about your experience in the professional space, just because a lot of the members either have ambitions to be in it or really try to see what they can learn from it and apply to their own trading. So, because like you said, you actually run a vol book professionally, which is really cool. Do you mind sharing a bit more about what that was like?
Yeah, so we had not a mandate, but it was strongly encouraged. We wanted to be long volatility. So what does that mean, right? So we had on a lot of positions. Some of what we did was take the other side of positions that banks didn't want to take because they were at their risk limits or they just didn't like the position. And then a lot of it was buying volatility where we thought it was cheap and selling it where we thought it was expensive. To be honest, at that point, the tools that we used were really just kind of looking through prices, looking at various filters on Bloomberg, and then putting together a portfolio. And a lot of the times we would be kind of what I would try to do is to buy longer term volatility because you have more time to sit with it. And then if anything were to happen, to sell shorter term volatility to monetize that position. So that was kind of a recurring theme with the way I would trade. So for example, I would try to buy, I don't know, 6-month options, and I would sit with them. There's a natural tendency for you to lose money on those, which will occur. So how do you combat that? You can sell short-term options. You can also carry a long delta in some of those names. And I think I was lucky to trade names where, that at that time, the market was ripping higher. And so I could carry a long delta. And I sort of had a stop out in a sense that if the market were to drop, my volatility position were to increase. But if the market were to drop a lot, my volatility position should, make more than my long position would lose. So it was a positively convex position.
It's really interesting to hear that your position in the vol space was primarily long vol, because mostly when I talk to people in the vol space, in the professional space at least, they're taking the short vol side.
Absolutely.
Right.
Absolutely. So you're swimming upstream.
Yeah.
And how do you fight that? So you can sell short-term options, so you're earning some decay. So your position may be decay neutral. Sorry if I'm getting too technical.
All good.
If you're earning some decay or decay neutral, that volatility position is probably not going to lose too much money. And you can also carry a long delta. And I did a fairly good job at that time managing my deltas. So I think there's a few things that retail traders can do in part of a portfolio is kind of take advantage of things that have been shown to work. So one of them is not buying options, right? That's off the table. But other things that have been shown to work is momentum. So how do you put on a momentum strategy? How do you construct a momentum strategy? That can be, you could do it 100 different ways, but it has been shown to work over decades now, right? And should it continue to work? Yeah, probably. Is it going to work at, when volatility is a little bit higher? So going back 5 years when volatility was really, really low, probably more difficult. So from the standpoint of what did I do back then that I could do as a retail trader, or just if I'm punting around, buying winners and selling losers, I think works. I don't think just doing it kind of, oh, this stock is up, I'm going to buy it. That's not really what I'm saying. Just putting together a portfolio. The other thing that I think can work, and is part of maybe a broader portfolio is, and it's been borne out in research that other people have shown, is if you buy 1-month options over and over again, you're going to lose money. But you can buy longer term options, and the decay and the loss is just a lot less. So that's something that perhaps you could incorporate as a hedge. So,
right. And that's kind of, it wasn't a part of the questions I want to ask, but it piqued my interest when you mentioned being long vol, because, even if it can be, zero expectancy in a sense, it's a good complement to a short vol book.
Right.
So do you mind sharing a bit about how you would price a long vol trade? Like find something cheap, because in a sense, it's like everything's looking forward. So are you looking for like what the market maybe is missing? Was there a lot of fundamental work done in it, or how'd you go about doing it?
Yeah, there was a little bit, not really that much fundamental work. This is going back to 2005, 2006, 2007, where volatility was really, really low. So in that sense, it would be like buying, so we have the pandemic thrown in there, but like owning options in 2017, 2018, taking out the episode in February of 2018. But if you're buying options that are really cheap and the market's rallying, you should be able to make some money. you can pair a long volatility position with a long position in stock, and if the market's moving, you should be okay. And back then, volatility was just really, really cheap. And it seemed like you could get stuck with certain things, but more often than not, you'd have the ability for a minor blip here or there to sell options against it. The other thing I did was, if going back, this is a long time ago, I realized, but the energy space was really, really hot. And if you're buying options and these stocks are rallying, pretty hard, if there's a downturn, right, those stocks are more likely than not really going to crap out. And so you have that long volatility position on, you should make money in that as well. And
just to clarify, when you're saying primarily being long volatility, I know you mentioned some delta exposure, but were you delta hedging these positions still, or was it like a long call, or was it like a long straddle?
So we would have hundreds of options on, and we would just look at, so for example, if I was long, the way in my head I like to think about it was, if I was long, say $100 of delta, or any amount of delta, I would think like if a 3 or 4% move down in that sector, then that would take me out of my position because of the options gamma. And so I would lean long primarily. Sometimes I would let it run, but I would primarily operate with a long position just because I knew that I had this hedge in my book. The other thing that I should mention is that in this hedge fund, we also had a convertible arbitrage book, which is, I don't know, I guess well, technically it's long volatility, but it really acts like a short volatility position. So those two things paired off. So there was kind of at a macro level a little bit more going on.
Yeah, I get what you mean. It's like it's hard to describe it perfectly in just the space you were in, because there's another part happening over here that's also considered and giving you room to do what you're doing.
Right.
Okay, that makes sense. So, well, maybe more generally speaking, because I guess you've had the professional experience and also a good amount of speaking with retail and getting to know them. What do you think are, given what you've learned, some of the biggest maybe mistakes or things that are missed by retail when looking at markets and thinking about trading?
I think the way I think about trading is there are certain risk premia or factors out there that you can harvest pretty consistently over time, I think. So, and there's research that have been done on this, and people have known about them for years. So momentum is something you'd have to construct a portfolio. The carry trade, so I'm kind of going outside of equities, but the carry trade is another one. Looking at the VIX futures, that's really just a carry trade inside of that VIX futures market. So those are things, if you can harvest them, that would be great. And then the other thing you can do as a retail trader is sort of, if you know of certain situations where the risk reward is high on your side, you can sort of sit back and wait and take advantage of those. So when you look at a lot of academic papers, they're going to typically do it more or less the same way. We're going to buy decile 1, or whichever way you want to talk about it. Buy decile 1, sell decile 10, and the returns make X% every month, right? And all those so for equity option papers, all those papers are done at mid-market. Once you start incorporating any sort of transactions costs, those returns sort of go away. However, if you kind of sit back and say, okay, this is the sort of trade I'm looking for, and however you're going to try to get notified when those sorts of things occur, you can put that trade on, and you're going to have a great risk reward. And it doesn't have to. So I always talk about the calendar spread trade a lot. I saw, and a lot of times you'll see someone in the market doing something. So when Bed Bath and Beyond, right, that stock had shot up and someone was buying a ton of upside calls. And I forgot to look at the vol, but my immediate reaction was sell the crap out of those. So if the strike was like a 25 or so, sell the crap out of that upside call and then buy some shorter dated or shorter dated, closer to at the money. I forget where the stock was. And your volatility skew is going to be such that you should be able to capture some of that.
So, well, that's kind of cool. It's like in these irrational moments, what you're doing is you're selling the further dated stuff because eventually it's not going to stay here, but you're kind of hedging it with the shorter term because it could rally like crazy in the short term.
Right. So I typically try to put on, think about how can if I'm taking a short vol position, how can it be hedged?
Mm-hmm.
And a lot of times you'll have someone come into the market that'll just put some trade on, and that's going to be a temporary dislocation. You could help sort of get it back into line.
Right. Yeah. I think that's like the sort of, it was like probably my light bulb moment, at least, was thinking about the market in that way, where it's like, how am I sort of able to add value to the market in some way, right? Things get out of whack. How can I help resolve that? And that's why I should get paid, right? Is for helping resolve these inefficiencies,
right?
Rather than just being purely speculative.
Yeah. The one thing that I would say is that I would really shy away from is using any sort of trying to get too involved with any technical indicators. I just think that those are, it's very easy to convince yourself that what you worked on looking backwards is going to work going forward. And I think that's very difficult to see it carry through. I think that's just really hard. Maybe on shorter time frames, I think that's probably easier to do. But if you're just working over daily time frames, I think it's a lot more difficult.
Because it doesn't really answer the question of like, why should this make money?
Yeah, you put a trade on it, so it's going against you. Are you confident that it's going to work, or do you, what are you really thinking? I immediately think I have no confidence that this is on. Like, why should this work?
I'm actually in the same boat as you. And probably everyone on this call is as well, actually. But speaking about the calendars and everything, what sort of brought us to this point was the group doing research into the forward vol work that you put forward back in 2018. So do you mind we'll start off, if you can just give like an overview of what the research you did was and the findings of that work.
Yeah, so I have, there's two papers. The one you're talking about is looking at these forward volatility agreements. There are a few different versions of the paper, but essentially what you're doing is, or what these agreements are doing is, you're buying longer term options and selling shorter term options. And it doesn't really matter in the research, it doesn't really matter what the maturities are. So like it could be a 6 month, 3 month, it's still going to make money, or a 3 month, 1 month. That doesn't really matter. You're putting these on by basically comparing the level of forward volatility to the current level of volatility. And really, all you're doing is you're looking at the slope of the term structure of volatility for that equity. So for example, if 1 month volatility is 20 and 3 month volatility is 30, you would buy the 1 month and sell the 3 month. So you would essentially be selling volatility forward.
Mm-hmm.
The other way is if 1 month is 60 and 3 month is 40, you would buy the 3 month and sell the 1 month, and you'd be buying forward volatility. And so if you do that, and it's that almost cookie cutter like in terms of how the papers proceed, mm-hmm. after the motivation and all that stuff, you're going to divide by price, basically the forward price, but really all you're doing is it's that slope, and you're buying calendar spreads when the 1 month is inverted over the 3 month. I'll just stick with that example.
Yeah.
And the other side is buying the 1 month and selling the 3 month. The vast majority of the P&L is coming from selling that 1 month and buying the 3 month. That's really what's driving the P&L. It doesn't really matter, like you think, well, how does it do during the financial crisis or during this period? It doesn't really matter. It seems to make money just about every month, more or less. it doesn't matter. So the first thing I thought of, oh, this is all earnings related, right? This is just an earnings story, and people are bidding up these short dated options. And I pull out all of the companies that are going to have earnings, and you see essentially the same returns, which always surprises me.
Mm-hmm.
But yeah, it's just there. So then you have to kind of, why is this the case? Like, why is it there? How much do transactions costs play a role? Like, if I were to take out, there's a few different ways to do it, but you could do it by market cap, you can do it by bid-ask spread.
Mm-hmm.
And does this dynamic still exist? And you see it's there, it's not as strong, but it's still there, and so it persists. So then there's a few different things you could think about is, well, why? And how do we explain this, and can we make money off of it, right? That's kind of the two things. Mm-hmm. So the explanation of that, and it's the way I think about it is, an earlier paper looks at, so there are essentially 2 or 3 options papers. 2 are 15 years old. One by this guy who's actually the co-author on this paper that we're talking about, showed that the term structure of volatility predicts the returns for 1-month options. So for example, when the term structure is inverted, you want to sell 1-month options. So that's the opposite of the VIX, right? There's this disconnect. When the VIX term structure is inverted, you want to buy VIX futures. When equity term structure is inverted, you want to sell them. So at some point, there's probably, I think ETFs are probably agnostic. But anyway, so you have that pattern. When 6-month options or when short-term options or term structure is inverted, you want to sell those options. And the opposite, when it's upward sloping, you want to buy the 1-month option. So what our paper does is like, okay, well, what's going on here? And so what we show is that term structure predicts jumps in the underlying or large moves in the underlying. And what we think is that this is sort of by selling those options, you're earning compensation for this potentially large jump risk, right? And the term structure slope also tells us that this jump risk is transitory. It's only going to be around for like a month or so. And it's just by looking out after a month after we see the term structure invert. And so the returns pattern that we see for 1-month options is very different than what we see for, say, 6-month options. So when the term structure is inverted, we want to sell 1-month options. But when the term structure is inverted, we want to buy the 6-month options. So I think right in the 3-month range, that slope really doesn't matter. And so that's the explanation for the forward volatility agreements. It's primarily driven by 1-month options. It's primarily driven by when the term structure is inverted, but you also see this opposite pattern on deferred options. That said, can you make money on it, right? Mm-hmm. So the way I would probably approach it, and I've recently looked at buying just let's buy 100 equity long dated options every month and try to apply some simple filters. And if you're trying to create this portfolio, it's just going to lose money. So really what you have to do is you have to sit back and say, what's an extreme term structure?
Yeah.
And you define that. I'm not sure how you define that, but you want something that's really extreme. And then what I would do is, once you see that, put the trade on either by selling the 1 month or putting on some spread, some calendar spread. The first time you probably put it on, it's probably going to go against you, right? Because who knows when these things stop. So maybe put on a little bit less. And so you can add to it. If you have some sort of counter spread on, you should be able to, that deferred option should help you in terms of margin, right? And then just, you essentially have to wait to collect that decay and then kick out the back option.
So just quickly about measuring the how extreme of a term structure we're seeing. Can you share some ideas that you've explored?
So in trading, going back, we would see, like, you would see if the 3 or 6 month options were 40 or 50, you may see 1 month options at 80 or 85 or 90, like things like that, where it's really, really steep.
Yeah.
And we would put positions like that on. In the research, it's just, I take the, I do a sort and I take that decile, and I don't really dig any deeper other than your standard filtering, making sure the prices are okay.
Yeah. I was wondering about like maybe like a relative steepness, right? Like I wonder if for like an individual equity, if you were tracking the 30-90, let's say, right? Because we have a metric in our platform where we're looking at a time series of the term structure, basically.
Right. Okay.
About 30-90, right? And I wonder if you could do like a percentile on that.
Absolutely.
Say. Do you think that's makes sense?
Absolutely. But you'd want to look for those extremes.
Mm-hmm. Yeah, it's like if it's not above you could test at building a basket above the 90th percentile or something.
Yeah. Yep. And wait for those to go on. And you could do that even for so that's calendar spreads. And you could do the same thing primarily for downward, for skew options, selling puts and buying at the money options. The margin's going to be a little bit cheaper. It's hedged. Your volatility day to day is not going to be as great. You're still putting the trade on. You are taking advantage of what is expensive, right? But it's doing it in a hedged manner.
Mm-hmm. When looking at a strategy like this, I remember when reading the paper, the basket of trades put on each month, it was a sizable number of trades, right? So from a retail perspective, that can sometimes get challenging to, so let's say you reduced the number of trades in some way, or was there any, for applying it as a retail, are there any adjustments you think that could be made without sacrificing too much of the returns?
Well, I think you would throw out, you probably do some filtering on what names you can actually trade, right? So you'd want to look at names. Maybe you're starting with a much smaller universe. I'm going into option metrics and I'm taking the whole thing. Yeah. Right. You're gonna be working with 100, let's say maybe 100 stocks or so, and then you just look for particular stock. It's at its 95th percentile. Put it on. Mm-hmm. Yeah. That may occur. How often is that going to occur? Not very often. But you're going to get opportunities, and you should make. You're going to make money most of the time, and you're hedged, right? You almost, in some ways, you kind of know what you can lose.
Yeah. But if you're if you're selling the short dated, buying the longer dated, you have a debit. Yeah. Yep. Right. So you should be okay. And one thing I was thinking here, just while you were talking, you kind of mentioned we looked at whether market cap impacted the returns, and it was like, not really. It seemed like wherever you were doing it, you were doing all right. So one thing I was thinking is adding a market cap filter as a retail investor, because you kind of get to double dip. You will have a smaller universe of tickers to look at, and there's a chance that there's better liquidity. Yep, absolutely. Right. And the other, so it depends. Like for I would want to stick with the same. Like if I see the opportunity in Bed Bath and Beyond, so I would think that there are opportunities in Bed Bath and Beyond right now. Like the front month's probably super high. The puts are probably ridiculously expensive. So there's probably opportunities in there. A lot of times, what I would do is I would, within a sector, and this is I think difficult for retail investors with margin and everything, but if you see 1 month options that are really expensive, you can sell those and buy something related, say 3 or 4 month options. It's interesting though, like if you're talking about like something that should typically be correlated because of sector relation or something like that. But what I feel like on my side at least sometimes makes it difficult is there's a reason that this correlation is broken now.
Absolutely.
Right.
Absolutely. So yeah, so like pairing Bed Bath & Beyond with Target is not going to help, right? So that's not really so you have those special situations. They are special.
Yeah.
Definitely.
So you mentioned with Bed Bath & Beyond, your approach or idea being basically to buy short dated option, sell a longer one, right?
So in that, when whoever came in and bought those they were upside calls. I forget what maturity they were, but my initial reaction is sell those options and then hedge them somehow. And probably the way I would do it is buy probably some shorter dated options. If I'm selling 10 of the options, I'd buy probably 5 of the at the money options and have some sort of ratio trade on. But that whole, I mean, that story seems like I'm not following the company really closely at all. I see the headlines and I see where the stock is now. And now I would have to think that the puts are really expensive. The 7-5 strike would be really expensive, and selling those and maybe buying a further out 10 strike put or something like that. I'm guessing the skew is probably pretty large.
Yeah, I feel like that could be an interesting approach with a lot of these like meme names. Have you looked at or placed trades like this in the past on maybe GameStop when that was happening, or any of these other similar-ish names?
So sort of, nothing recently. But going back to the late 90s, I was working at PaineWebber, which was bought by UBS over 20 years ago, and I was trading all the internet names then. And so they were like the same sort of thing, and not like GameStop it's in a class all by itself, but you have these stocks that were just rallying all the time.
Yeah.
And I was just buying options, just like I was talking about earlier with the energy names. As they're rallying, buying options and maintaining a long delta. So these stocks that are rallying, buying options, maintaining a long delta, you're sort of, you have some protection as the market's rallying, and then when it unwinds, you're doing better on the unwind. I've looked at researching this, so some sort of buying options on momentum stocks, primarily going up. And I haven't been able to find anything. I need to go back and look at that, because I think that there's probably something there. But I wasn't able in the first run through to find a relationship there. But it worked for me in 2 different occasions, 7-8 years apart, I guess, or more than that, in 2 different sectors.
Yeah. So mentioning sector there, what I was just thinking, because first with mining, and then was it some sort of tech for the second one? Sorry, I missed the sector.
Yeah. So that was tech in the late 90s. So that was a lot of companies that you've never heard of. CMGI was this one company I remember. They briefly named Gillette Field where the Patriots play, and then I think they went out of business like 6 months later. So they were I think an incubator of other internet stocks or something. So that was a big one. And then all the kind of the legacy names that, AOL, Yahoo, what else? eBay, Netscape.
Yeah.
Yeah.
That was one of them.
Those names. Pets.
Pets.
Yeah.
I'm because one thing I'm thinking here is like, do you think there's signal in not just individual name performance there, but it almost seems like a sector momentum?
Oh yeah, in those cases it was definitely and the individual names are usually going to be cheaper than, well, there were no ETFs options back then, but the ETFs, I think the vol might be a little bit more expensive, but it's easier to trade. So I think it depends on the sector. In the mining sector, those like I trade a lot of gold names because I traded the underlying as well. And the ETF there, the correlation was so high among the names that there really wasn't this additional premium on the ETF. So I could buy those options as well.
Yeah, interesting. We actually, just the previous interview from this one, we were talking in depth about implied correlation and any opportunities around that for ETFs. Is that something you've looked into yourself?
Sort of. So we would sort of do that if we were buying. We typically would buy when I was trading equity options and then sell index options. Either I would do it or kind of the head of the whole book would do it. Sell index options. But one thing that I need to look at from a research standpoint is if you think about when the term structure is inverted on equities, you want to sell those short dated options. But when the term structure is inverted on the index, you want to buy those options. So what's going on there? And so there's a, are the index options then, or VIX futures cheap? Like, does that make sense? But I think if you look at it from a correlation standpoint, what I'm guessing is you're going to find that the implied correlation is probably higher, and you have to look at it as a basket. So kind of going back to like the whole, sort of in a CAPM framework, you can't just look at the index on its own. You have to look at the index and the components. You're going to find somewhere, right? Something has to be expensive there. And my guess is it's this implied correlation. I just haven't looked at it yet.
Yeah, I think there's already a good amount of research in that space that would suggest it. But yeah, let us know what the alpha is when you find it.
Sure.
Let me see here. What about current research, right? Are you still focused in the term structure space for the most part, or anything new on the radar for you?
So right now, I need to clean up those 2 equity papers and get them submitted to journals. My first paper, I should be doing that this month. The one with Matt Lynn. And then a lot of what I'm doing is in working with this fund, looking at more index vol strategies and trying to get those up and running. So some of them are based on the VIX term structure, which people have, I think people know about that. And then some of them are other just S&P option structures that I've been looking at to try to get a balanced book in the index space first before moving out into the individual equity options. I think to move into the equity option space and do it systematically, it's a lot of work. And we're not ready for that yet.
A lot of the times that I speak to people managing capital in the vol space, a lot of them are focused on ETFs as a whole. Do you think, is that primarily a capacity reasoning, or what do you think?
Probably. I think you can, you can, there's size in there. You can trade one against the other. You can put a simplified dispersion trade on using those against the index. I've looked at those briefly, and I just haven't seen the alpha kind of pop off the screen as you do when you look at equity options. So for index options. So for index options, if you're going to carry some short volatility position, the question is, when do you carry it? How do you carry it? And then I guess, how do you hedge it?
Yeah.
And then how confident are you that what you've created is going to work going forward? Like I'm always this is, perfect is the enemy of good, right? I always want to take a strategy and then kind of add in some defensive stuff to it, just to make it, I think, a little more robust and be a little bit more comfortable out of sample.
100%. It's like it's like there's something we're trying to capture here, a reason that we're supposed to make money. Right. I want to hedge away everything else, or as much as possible, right? Because in the end of the day, like what I try to talk to our members about is you're getting paid for a reason, right? So you can never hedge away the reason, because then why are you getting paid?
Right.
But you can get rid of all the other risks, right? If you're a short vol and that's your view, why do you have delta, right? As a basic example. So it sounds like something similar is the way you try to think about further developing your strategies.
Yes. And how can you put on a long volatility position as cheaply as possible? Can you do it with how much can the structure help? That's difficult, right? So maybe at the outset you have your flat delta, your flat vol, but if the market moves, your position changes and you become long vol. Can you construct a trade like that?
Interesting. Can you give me like a more of an example of that? How you would change it from short to long vol?
Yeah. So one thing that I was actually just looking at this afternoon is, can you put on a trade where instead of just buying outright puts, you sell let's say we sell if the stock is 100, you sell a 95 put and you buy 2 of the 90 puts. So at the outset, if you look at all the Greeks, the vega is going to be flat, the gamma is going to be flat. If you get a move down, that long piece that you own should increase in value relative to the short. You're going to get long volatility. Okay. You bought it at a higher vol, I know, but you're still going to get long volatility. How do those trades perform during events? And then what's the cost of carrying that position? If you can exit it, hold it for a month or 2, and then exit it, and you're not anywhere near the short strike, you should be able to get in and out, and the cost isn't that great. It's still probably going to cost a little bit, but it's not going to be that great. If you get the move through, it's probably going to make a fair amount of money. So there's these trades that are on that don't really look like anything unless you get a move downwards. That's purely a defensive strategy.
Yeah, I want to ask you about this a little bit more because, and I'll start with an example from things we've been looking into. Like we said earlier, it's having a long vol as a part of your book. Anything long vol that's positive expectancy is a nice piece to have in your book, right? So something we've been looking into, for example, is buying vol pre-earnings, where you think the implied move will increase.
Yep.
Right. And I wanted to just pick your brain a bit here and see, like, are there other areas that you've looked into to try and find this golden hedge, we'll call it? And if so, like, what kind of areas were you looking?
So that's something that we used to do all the time. We would want to own the volatility pre-earnings, just because we felt that the volatility was always, there was going to be some backstop there. And so if anything happened before the earnings, great. And then we have the event, and going into the event, if there are buyers of options additionally, you can put on some sort of spread. And we weren't market makers, but we saw a lot of the flow coming through. Yeah. The other thing is, longer dated options are going to be cheaper to carry. Anytime you can have an option and you're going to sell it before, let's say, the last month of expiration, if there's that vol premium when you bought it, it's still going to be there when you sell it, right? So there's that cushion is still there. It ultimately goes away when you're just comparing the realized of the underlying to the implied. It's not a implied to implied trade. The other thing is just trying to figure out, like, we're having this conversation. So from my standpoint, how do you, like, with the VIX at, I don't know where it closed today, mid-20s, it's hard to find something that's relatively cheap at this point. So the way I'm looking at, if I'm trying to construct some sort of long volatility position, is add it when this doesn't really help now, but add it when it's cheaper and just warehouse it in the cheapest way possible. And then you'll have it, if an event occurs. So perhaps buying an at the money put and selling downside puts, you're collecting that skew, you're still long volatility. From a hedging standpoint, it's not the perfect hedge, but if the market drops, you're going to make money.
let me ask you this. This is going to be an interesting one, I think. So, as a retail trader, one of the sort of maybe inherent advantages is being able to handle more variance than a firm, right? You know,
Right.
if you lose 5% on your book, there's no one tapping on your shoulder saying what just happened.
Exactly.
So when we're talking about hedges, right? Do you think that a sophisticated retail trader who maybe has a healthy appetite for risk should be thinking about them maybe a little bit differently, and because when you're reducing your variance with the hedge, but you're also potentially reducing your long-term expectancy, right?
Yep.
What are your thoughts on that?
Yeah, that's a good question. I don't know, if you're looking at it from a margin perspective, I don't know how much the hedge. So if you look at, I don't know, X amount of money selling a 1 month straddle versus X amount of money putting on some hedge trade, can you put on more? And the fact that you can put on more, does that ultimately make you more money because you can increase your position? I'm not sure about that. But you're right. If you're willing to take the risk, is it necessary to, is it as important to hedge?
Yeah, like it's like if you have an idea of what your variance should be, you're not trying to go from current capital down 80% and try and climb your way back up.
Right.
But maybe you can just adjust your position sizing based on your thoughts on like the variance you can expect.
Yeah.
Right?
And if you're delta hedging, you would delta hedge less, I guess. You would try to minimize transactions costs or whatever.
Yeah.
You're less.
Yeah.
Right?
Right?
I don't know if there's a sweet spot between it for hedge, you want to reduce volatility, increase short. Retail trader they're not looking at their short. But can it help increase a position through, better, just that the position is handled better from margin perspective?
Yeah. I guess that could make sense too. It's more like or if you can let's say a lot of our members are trading earnings, for example, right?
Okay.
And they're basically just selling vol around earnings events, right? If we're doing that though, right, and then it's like, okay, should I remove some capital from, let's say you're trading these earnings events, like if you have a 25K account, you can't be putting on an Amazon short straddle because
Right.
you understand that the variance on that could crush you, right?
Yep.
So you're sizing things correctly, but a lot of members, what we've been thinking about is going maybe a bit above that and finding another hedge somewhere else to reduce the variance. But are we also reducing our expectancy by doing it? Should we just have all the capital in that strategy?
Yeah. So for earnings, I think you're selling a straddle or a strangle, and that's your trade.
Yeah.
Because aside from what I found when I tried to pull earnings out and keep them in, the term structure is inverted because of earnings. The term structure flattens more or less after earnings. The hedge you're buying is, that vol premium in the hedge is going to go away, just like the vol premium you're trying to collect, that's going to go away as well.
Yeah.
So you're not really capturing, you're not really gaining anything by having it there. If it's expected and you want to, the options are too expensive, then you sell the options.
Yeah. Oh, so one thing that we were looking at as well is using the trading the increase in implied move as the hedge, right? So you have some that are like earnings is maybe a month out and you're holding a long straddle there while you're selling vol on names that are having an event in the shorter term. Something like that.
That is what we used to do. That is, yes. Can I own some volatility where I think it's going to be stable? Yeah. And then how do I monetize it? So I always would say we have this backstop in the name that's going to have earnings coming up, and we can monetize it through some other names. Yeah.
So if we're not getting too deep into the alpha that was being traded there, I want to ask you how you were measuring whether the implied move should increase approaching an event when you were trading this pre-earnings vol.
Didn't really look at it too much, to be honest with you. We knew that the earnings were coming out. We figured that the volatility would be either constant or increasing into it, more or less, and we would buy the options. I didn't look too heavily at the fundamentals of, oh, I think this is going to have a big move or a small move relative to where they were. Just own them, and if in some names where maybe there was additional hype around the name, you may find that it would be more reactive. A lot of times you own these options and see what would come your way in terms of if someone wants to buy something ahead of time, and then you could sell it. And also, when I was in the energy space, the moves in those names typically on earnings weren't as large as in the tech space. And in the past 2 years, we've seen just mind-blowing moves in some of those names. In energy, you would get every once in a while a move greater than 10%. I think it was relatively rare. It was still, it could move around, but you wouldn't get this huge increase in implieds.
Yeah. Nowadays in tech, you're lucky to find the name that isn't implying greater than a 10% move. You know,
right?
Like anything less.
Oh
than
yeah,
that.
absolutely.
Yeah, it's every name's implying at least 10%.
Oh yeah.
So I have just a couple more questions for you here. I think we can squeeze them in before we get to 8 p.m. I wanted to ask your thoughts on systematic versus discretionary approaches to trading strategies. I think everyone here is pretty much in agreement. Like, you need to price the vol, but how much time should you spend looking for like one-off scenarios where vol might be mispriced versus some more like clean-cut risk premium oriented strategy, something just a lot more systematic? What do you think?
Yeah, so for systematic, you kind of know what the trade is. How do you implement it? I think you could come up with some rules in an Excel sheet. I have the VIX futures downloaded from 07, right? So you could build strategies in there, and they're probably going to do okay. Use the term structure to get out. Don't sell vol when it's too low. I mean, some simple rules. But then the one-offs, I think that's you can have some basic ideas, like when a certain spread or implied vol gets too extreme, put those on one-off trades. You can sit and wait and do those. You're probably going to have a high hit ratio on those. You just have to be on the lookout for them.
Yeah. Do you think like okay, interesting. Just one of the people on the call here wanted to ask, do you think in a sense this is what alpha versus beta might look like? Right, these individual one-off situations versus the more systematic approach.
Yeah, so the systematic is the beta. You're just harvesting that risk premium. Yeah, I would. That's a good way to look at it. It's a clever way to look at it. And you're paid. So I know that if you come up with I've been told, don't say you're harvesting a risk premium, because if you're harvesting the risk premium, you're not going to get paid as much from an institutional standpoint. So you have to come up with different ways to express that.
Yeah, you gotta say it in a more creative way. Come on.
Right, but no, that's a really good way. If I just buy equities, right? I'm not really generating alpha. If I'm just selling vol, it's not really alpha. It's just a different risk premium.
Yeah,
and
it's just equity risk premium and a little bit on top.
And vol risk premium, yeah.
So let me ask you this. When it comes to these one-off situations, how much time do you spend actually trying to price the vol around it versus understanding what's happening around the stock and why we might just be seeing because sometimes vol can be high for a reason, right? It's going up for a reason. How much do you balance the what do you think the fair value of vol would be? And if you can share maybe how you go about doing that a bit versus hey, it's all these, retail investors driving this thing to the moon. It doesn't really matter what the fair value is. It's crazy right now. How do you kind of balance these things as in a hypothetical?
Yeah, so I guess in looking for extremes, I don't know if I would look at any, I would look at like for 1 month options or for 3 month options. Where has this been in the past? Like, are we at 95th, 99th percentile levels? Knowing they can go higher, but this is really extreme. And a lot of times with these, when you see these situations where the vol is distorted, I would typically think, okay, can I go into this and put on some sort of spread trade? So that the spread between the two options I'm trading, the vol, it's just ridiculous. I'm not really looking so much at how much you're really getting out of looking at past realized versus implied. Like, I don't know really what I'm getting out of that.
Yeah. Yeah. And like, like I think like some interesting ways, something I was thinking about, for example, is comparing it to other stocks that it's happened to.
Okay. Yeah.
Right. Like, for example, if, one of the trades, it was, when was this? I think it was late last year when Rivian went public.
Okay.
And it just went to the moon.
Right.
And options come out. They're trading it. It was like the 1 year options are trading at like 150 implied vol. Sold, right? Like sold
right,
in size. Like these are the ones you got to cash in on.
Right, exactly.
But so what we were kind of doing was we were just comparing like, okay, like here's the market cap, right? Here's the kind of size. It's like, okay, what happened when GameStop was around this size as well, right? Things like that. Do you think do you think it's one of those where that analysis is actually informative, or was it just like a blatant sell anyways, and we're just doing it to make ourselves feel better about the trade?
Yeah, well, that's fine. But you could, if you look at how companies going public, what their move was out of the gate, and then what is it a month or two down the road?
Yeah.
Right. So, and that's an advantage if an institutional investor came in at those options and wanted to get any size off, they're going to knock it down 30 vols, whereas you can get your position. So that's a big advantage. Because you can have issues getting a position on, and then you can have issues hedging your delta as well, where you're actually impacting the stock if you have a lot of gamma on. And by you stepping in and trading your vol, you're muting the volatility. Like you can see that, and you kind of have to let it run.
Yeah. I think that's really interesting. But because we're short on time, I have one last question. It's my favorite question to ask. Is a lot of good stuff comes out of it. Tell us a trading story. Tell us a story. It can be something funny, can be a good trade, a learning lesson, whatever you want.
So I have two stories. The first I always tell when I'm teaching options, because when I walk through options, it's usually just European option. We don't worry about early exercise and go through why would you ever do this in case the stock's really deep in the money, a call option you would exercise for the dividend. So I was trading, I forget what stock, but it was German. And the dividends over there are typically once a year, I think. And they had an annual meeting. So they have an annual meeting on, let's say, Wednesday, and the dividend is, the stock goes X on Thursday. So I said, all right, I had a call option. It was like $6 in the money. I exercised some of the options like 2 days before just to make sure that it worked. I was in New York. We didn't really have a London office yet. So I did it, it's fine. And I exercised like 10%. And then I went to exercise the rest, and they said, oh, we can't exercise. I said, well, why not? So there's a German rule. You can't exercise options the day of the annual meeting. So it was like $5 it was like a $400,000 loss.
No.
And my boss was just like, he's just like, you could lose money, but you can't lose money like that.
Yeah.
So that was in.
Was it one of those that like your boss was aware of this rule, for example, but it was one that you're like,
oh no, he didn't know the rule.
This.
No one knew. That was the problem. No one knew the rule. We didn't have anyone in London that traded options.
Everyone's
Yeah.
just sitting there with their like heads like, oh my God.
Yeah. And then the other one was, the only time I ever saw, or one of the few times I saw an arbitrage example was, this is going back a long time. And Warren Buffett every once in a while would buy silver. And so he would buy it through this commodity trading company I think he owned a piece of. And silver was going crazy. And the options market, you would have the London market, it would kind of close at 8 a.m. And then the New York market would open at like 8:25. And so I think it's NYMEX now, but it was the COMEX silver options opened. And we had just seen where the over-the-counter market was. And the options were just too cheap. So it was like this one time where you had, the one market was, let's say the vol was 25 and the COMEX market was 20. And I was only like 6 months, I was under a year, I think, in the job. And I said, buy as many, if the option was 3 at 4 or whatever it was, I said, buy as many as you can up to $5. And I forget what we got. My boss just looked at me like, he's like, whoa, whoa, whoa. And it's like, we bought as many as we could. And then someone else came in and bid it up through it. So that was pretty cool to see, like this, where I just came in and just took as many as I could.
That's so good. Especially like being new on the job. You're like, listen, fire me if it doesn't work. I got this.
Yeah. So that was the trading can be so much fun. And then you can have months where it's just miserable.
Yeah. That's that tends to be the way it goes.
Yeah.
Did you do you mind if I ask, like, how much size did you actually get on in that trade? I feel like it's always fun to hear these.
I think I probably got 5,000 contracts on, which was like a normal. So it was you would either trade in like 1,000, 2,000, or 5,000 typically. I think I got 5,000, probably between 2,000 and 5,000. So like a decent size.
Yeah, making
Not
it
huge.
Yeah, but the spread was huge. Like what you stood to make was like
Yeah, we made money immediately.
Yeah,
so that was
crazy.
That was pretty cool.
Yeah,
and that market, there are things in the commodities markets that you find where, like, during that time, and it was also a time when Russia wasn't going to ship palladium, and so palladium actually had, like, the market just disintegrated. There was no offer. You couldn't buy the physical palladium, and the silver forwards are doing the same thing. And we had this odd dynamic where when the silver price rallied, the forward curve changed so much that I'm not going to explain it properly, but by owning options, we were short gamma because the forward price was changing opposite the spot price. So you just wouldn't look at it.
Wild.
Yeah, so like the forward price would go from 5 to 480 as the silver price would go from like 5 to 550, because the forward curve was just crazy.
You mentioned this Russia thing. I just quickly here, one last thing. That was something that happened back in the 90s, you were saying, I think?
Yeah.
So, it kind of makes sense, that a large, like, macro event of that nature can create these, like, interesting messed up prices that can be taken advantage of. Do you think it's reasonable to still look for things like that today? Or do you think with the technology and flow of information that efficiencies have arbed away a lot of that stuff?
We saw it. I mean, oil went below zero 2 years ago.
Yeah, that was cool.
In 08, oil got so cheap. It was, I think some of the banks it got below, let me get this right. They were just buying the oil and storing it offshore. They were just taking delivery and holding it. So I think you can see some of those dislocations. Some of those markets, like in agricultural prices, if you can get a handle on that, I think you can see opportunities there. I don't know anything about that, but I'm sure that those are the types of markets where you'll find things.
Okay. Jim, thank you so much for your time. This has been an awesome conversation.
Yeah, great. Thanks for having me. Appreciate it.